6 key ideas from the Little Book of Common Sense Investing. Number 1. Actively managed funds are expensive and consequently often underperform the market. Stock price speculation is just not a viable tactic. You might believe that a fund can make enormous profits by, for instance, purchasing stocks at a discount and then selling them at a higher price. However, over the long term, this strategy will not be able to outperform the earnings of the underlying companies, which will be reflected in the overall performance of the stock market. Number 2. Few funds perform well, and there's no guarantee even those few will continue to do so. If you want to overcome the odds, you can choose to put your money in investments that routinely exceed the market. Even if you look at their prior performance, it's possible that the circumstances that made the fund perform well for 35 years won't hold true going forward. Number 3. Most people invest in actively managed funds unaware of all the implications. Recall the risky investments from the late 1990s. People invested $420 billion in the stock market in the second half of the 1990s, when the market flourished and equities were overpriced, compared to just $18 billion in the first half of the decade. People only recognized they had fallen for the popular excitement when the bubble inevitably broke. Investors pour money into actively managed funds because they see others doing the same thing, which is consistent with the same premise. Number 4. Put the majority of your assets in safe, low-cost index funds. Index funds, also known as passive funds, monitor the performance of all the stocks included in the index without making investments in specific stocks. You won't have to pay operational costs for share buying and selling, financial advisors, or fund management, because they only had shares across specific market sectors. However, you will gain from commercial net returns. Index funds also have the potential to beat actively managed funds over the long run. Number 5. Choose the cheapest index fund. A management fee and operational expense percentage is included in each index fund. Despite usually being less than 1% overall, this cost can build up over the course of an investment. The annual cost ratio for the JP Morgan Index Fund is 0.53% compared to the Fidelity Spartan Index Fund's 0.007%. Both funds have costs around 1%, but over longer investment horizons like a decade, those tenths of a penny add up. Number 6. Be wary of new investing trends. The new Copernicans, for instance, refrain from building their portfolios with stocks selected using conventional techniques, such as weighted market capitalization, in which stocks are purchased in proportion to each company's total market capitalization, which is calculated by multiplying the total number of shares by the average share price. Instead, the movement may choose the quantities of each stock in their portfolio depending on factors like the amount of profit each business makes or the amount of dividends they have distributed.
That's all for today's video. Let me know your thoughts in our comments section. Like, share, and subscribe.